Okay, very good morning. It is Wednesday the 11th of April. Quite a lot for me to get you up to speed with. And as you can see, we'll look at the charts, the setup for today, and obviously some important economic data coming later in the form of US CPI and also the FOMC minutes, and we'll have a brief discussion about that as well. But definitely not short of news flow from lots of different perspectives, from Chinese economic data to geopolitics, Russia, Syria, lots going on. And what I do think is happening a little bit at the moment, particularly given the gravity of the importance of this trade war or potential trade war situation, which seems to have dissipated, at least for now, a little bit from some of those conciliatory comments from China yesterday. But the point being, if you're an investor, I think it's a little bit difficult at the moment to really get a good sense of market direction, because sentiment has been incredibly choppy, given the kind of tit for tat that we were seeing over the course of the last week, of course, between the US and China. So with that in mind, I do think that overall with your strategies, being particularly aggressive in this market, I think would be probably the wrong approach. I think a little bit of conservatism might be warranted at the moment, given that there really is, I would say, from a global kind of macro fundamental short-term view, it is a bit hard to call at the moment, and this is supposed to be my job for the last 12 years. So if I'm finding it hard, any of the newer traders in the market, don't worry if you're trying to feel your way through and navigate this kind of flux of information we seem to be seeing at the moment, because everyone's in the same boat. I just think that then being more prudent might be just being a little bit more conservative with your kind of ambition on your strategies in that regard. The difference being, if there was, of course, a breaking headline, let's say, and we have been seeing this, is kind of just being aware of the narrative, so that if Trump comes out or China comes out and kind of goes against what's happened in the last 24 hours and reignites this trade war fear, then if that's when you might get a certain catalyst and the market could move. Certainly, we did see yesterday a real clean example of that. And I just have this graphic that I pulled from yesterday. I managed to save at the time. And you'll probably remember this, because I know in the live room, a couple of you guys managed to get hold of this move. And what I've got here is an overlap of the euro-dollar pair and Bund futures at the bottom. So complete inverse relationship, as you can see. This came on the back of some comments from ECB member Ewald Novotny, the Austrian central banker of the ECB, who said the ECB could lift deposit rate to minus 0.2% from minus 0.4% to start the process of rate hikes. And this obviously caused an immediate strengthening of the euro currency and saw a spike in German 10-year yields, so the Bund fell quite sharply as well. So the reasoning behind this, most simply, that the expected timeline of an interest rate hike from the ECB, of course, is not until really the summer of 2019. So we're a long way away from interest rate rises in Europe. Don't forget, we're still buying 30 billion euros worth of bonds every month as far as the ECB is concerned, and they need to stagger that down throughout the coming months. So the fact that they're having discussions and not just talking about a incremental 10 basis point, let's say, potential decrease in or increase in interest rates from this deposit floor negative 0.4, they're talking about halving it. And this definitely was a hawkish surprise. And this is a little bit, I would say, central banking 101 communication tactics, because what happened later on this afternoon, well, then the ECB comes out in a different press agency and says, this is purely Novotny's view. This isn't the ECB's view, this is just one guy's view. So it's almost like the central bank is testing the water as to how the market is positioned when they start talking about rate rises, of course. So very interesting and a fast money move yesterday, but I know some of you guys were armed and ready and you managed to catch that move. So that was really excellent work, well done. Quick recap of other things that we've seen though from yesterday, then we'll have a quick look at the charts. As you can see, this is the heat map of the S&P 500 from yesterday, and if you look at things, there's a particularly bright green spot, and not just basic materials, but Facebook shares. Facebook shares were up 4.5%. So if you think about it, look at technology overall, pretty decent performance as a sector, and obviously this carries a meaningful impact for the S&P, given it's the second largest proportionate sector of that index. And of course, it was the technology weakness which was another key catalyst for the sell-off in financial markets that we've seen over the last kind of fortnight, if you like. So technology's on a bit of a rebound. That was being led by Facebook. They were up 4.5%. You might have watched yesterday, Zuckerberg was in Congress. I don't know what I feel about congressional hearings with these matters, because I watched it for, I don't know, 5-10 minutes, and it was almost like the naughty school pupil put in front of the headmaster and they just tell him off. Very little, I think, really comes of these events other than a media fanfare of interest. One of the interesting things is, and I guess ask yourself this question, even what has happened here with Cambridge Analytica and its kind of improper use of the data from Facebook, has that stopped you in the way of which you now use Facebook? Has your behavior on Facebook changed at all, given the information you now know? I know, for one, it's not changed my behavior at all. So I'm not sure really about, you know, what they're going to get out of this, other than one thing from a market perspective. If you listen to Zuckerberg, and this is really the human behavioral element of how we as investors, particularly speculators, like to react to this type of event, is that Zuckerberg came out and the first thing he said was that I take full responsibility, I am the CEO, this is my fault, I will rectify the issue. And us as humans, when someone takes responsibility and they come up with a, let's say, as clear a plan and a commitment to make things right, well, this is what happens to the share price. And Facebook shares were up more than 5% at one point. They were already outperforming the FANGs before the event began, but they added about another 2.5% while he was speaking. So he's come out quite favourably from his initial response to this at the moment. And I point this out because I think it is quite key, just given what we've seen, which has been some increased negativity around the tech sector. That seems to have passed now, at least for the time being, that is. Just having a quick look at the charts then before we move on with some of the other news stories. You can see here the dollar a little bit softer this morning. The dollar index is trading down about 0.2%, so both major pairs are supported. Now, one of the questions I had yesterday was, you know, why the dollar weakness? And actually, I heard Safe talking to one of the newer traders on the floor. Is exactly right. We saw that really extreme spike in the euro. And don't forget, when you're looking at things like the dollar basket, the euro comprises of over 50% of that entire basket. Although it's comprised of things like the yen, the pound, and so on and so forth, it's the euro which is most influential to shift that dollar index. And with the huge spike that we saw on that hawkish Novotny comment, it depressed the dollar, and so consequently cable also saw some strength. Not only this, although things have improved on the trade front between US and China, I do feel as though this is still at the forefront of investors' minds, and so it does have a kind of lingering effect of potential dollar weakness because of the retaliation effect which we discussed before. This then, of course, coming in the wake of what is a hawkish communication from the ECB, is keeping euro dollar quite elevated this morning. And if you look at the currency pair, you can see here, this was the Novotny spike that we had yesterday. So we're trading above that point at the moment, actually, this morning. So you've had a bit of a continuation. Just having a look on let's have a look at a longer time frame where we are in the grander context. So now that we've broken that level, that R1, so 24.48 in the futures, you can see that pretty much lines up with these levels here. I kind of had circled as a band of kind of potential area of resistance. Any push beyond there starts to potentially open up some further upside. And how far euro dollar can get up today really is going to be dependent on later on this afternoon, because of course we've got US CPI. We know the importance of what the Fed place on these inflation readings for subsequent monetary policy decisions. If we get a low CPI print and we force the dollar lower again, in the backdrop and context of a hawkish ECB in the last 24 hours, then certainly we could see some decent moves to the upside, R2 and above the kind of 12th high 125 handle. That definitely couldn't be ruled out in the right setup if we get the US data come out on the weaker side on the inflation front. Cable, likewise, being supported, I think, more by the dollar play rather than sterling specific. Talking to a few new traders on Monday actually about how you kind of map through this expansive universe of information in terms of a hierarchy of influencing macro factors. Well, again, Trump and trade is top of the agenda. If you think about the news that you're reading at the moment, pre the transitional deal that we did about 2 weeks ago, everyone was talking about Brexit. When was the last time you read about Brexit? It's like it's kicked the can down the road. We'll discuss it again. It probably will come up when we have the May local elections, when summer parliament session discusses the EU customs union, but then in October, later this year, it will be right back up the top of the agenda again, because that's the informal deadline, if you like, for ratification from European Parliament. So just quite interesting when you're trying to fathom what type of news is moving the market on an intraday sentiment basis. This is how you can see how you can almost predict, in a way, the kind of intensity of these issues. So Brexit definitely has fallen off the agenda. I don't think that the sterling or the cable move higher is anything really to do with new news on that regard. Although if you read the papers last night or watching Twitter, apparently a wealthy individual has stumped up £50 million in cash in order to entice a new centrist party to come forward and to basically get this divide that we've got of extreme socialist Labour politics comparative to this kind of existing conservative stance. Some murmuring about David Miliband coming back to the fray. Definitely could be interesting, I think, but this is all kind of domestic politics, not so much for trading the pound today. Looking at the pound though, a little bit of a longer time frame. These are some previous annotations I had from the beginning of, well, really the course of March, I guess. And one of the things here is, now that we've broken that high that we printed on the 28th, which was basically R1 from this morning, we're now targeting R2, and you can see here that price has had a pretty decent run up this morning, because really technically it's not a great deal here. You've got R2, which is around about where we had the post-wage data move. This was the volatility, of course, over the Fed hike but dovish kind of rate trajectory that we had. That was the blip high just above R2, so probably be looking at there for some potential resistance on the way up. Then really we've got to target the high that we printed in the wake of the agreement on the transitional deal. That would be up akin to the 43 handle. To be honest with you, whether we'll get there today or not is yet to be seen, but I think it's only a matter of time before these highs get breached. I don't think it's a matter of if, it's a matter of when. Because when it comes to cable, looking in on a longer time frame, this is quite a key level we're trading at from a longer term perspective. You can see here really we're at the test of these levels which we were at the beginning of the year. We got close to that when that transitional deal was struck, and here we are about 50 pips from that level. I do think that this is going to get breached in the next week or two. As I say, if you did get weak CPI from the US this afternoon, and that resulted in weaker dollar, then certainly we could breach this mark, and it starts to open up technically some clear space to the upside. Calls of 145 I don't think are unrealistic for the more medium term. And who's to say we don't go all the way back up to this kind of EU referendum high where we were at 150 in the longer run? Certainly I wouldn't say that that's not impossible. Certainly if the trade talk materializes in a way that weakens the dollar. Alright, back to the news. A few other things quickly to get you up to speed on. I'm mindful of the time. So China, overnight, a couple of things to be aware of. China's factory inflation slowed for a 5th month while its CPI retreated from a 4-year high. So A little bit of movement in Chinese data, consumer inflation. China softened markedly last month as food price growth eased, and the base effect from the Lunar New Year holiday faded. Don't forget, what do people do in China during the Lunar New Year? I, being half Chinese, I eat lots of food. Believe it or not, I've got a huge appetite considering my physique, and like all other Chinese people, pork products very popular, and so that causes a short-term seasonal spike in inflation, and so this is kind of being faded out. So I don't think people have got too spooked by the CPI component in that respect. What else has been happening? Well, you've probably read about the likes on the geopolitical front. Attention remains on Syria. Heavy flights of coalition aircraft have been witnessed on the border with Iraq. So we're looking here, this situation, and obviously the Russians, the historical context, an alliance with safeguarding this particular region has brought about interesting things from US President Donald Trump, who's intensified preparations of a US response to a suspected chemical weapons attack in the country. And so, you know, geopolitics is also heating up at the moment, and obviously this very sensitive area, because I heard a squawk this morning that further missiles from Houthi militia have been fired out of Yemen, hitting southern Saudi Aramco facilities in the southern part of Saudi Arabia. And obviously this comes after several missiles have been targeted at the capital, Riyadh, and as far as Saudi Arabia are concerned, anything coming out of Yemen is indirectly under control then of Iran. And so you can see how we are simmering at the moment in the Gulf. And this comes, as you probably would have read, with Mohammed bin Salman has been taking selfies with Emmanuel Macron, the head of Monaco, the head of Lebanon. He's on a little bit of a tour at the moment for this whole push for foreign investment into Saudi as part of their Vision 2030. But at home at the moment, things are pretty tense. So definitely, if you're an oil trader, I do think these sorts of things need to be monitored at the moment. Obviously, with Russia in focus, I know Safe talked about this a lot yesterday, but just to give you a snapshot, Russian ruble, the local currency, under fire again. At the moment, we're already halfway through the week. It's going to be the worst week since 1999, and who knows where we're going to end at the moment. You can see here, we've only tested that a couple of times. I would imagine this was 2014, so I guess this was the Russian-Ukraine crisis, and then going back all the way into the late 1990s. So Russian assets definitely seeing some heavy outflows at the moment. On the geopolitical front, while I was on the subject, I thought I'd just remind you of this book. I know I've kind of mentioned to you all before at some point, but for those who haven't heard me mention it, I think Tim Marshall, who has written this book, who's the author, I think he probably owes me at least a couple £1,000 in commission here. But no, I do point this out because it's a really excellent short read, and if you have time, it will for sure increase your understanding of the current geopolitics that are taking place. On the oil front, I thought I would also cover this in the headlines this morning. Saudi Arabian Oil Minister Al-Fali says, happy with the oil market at present. A little bit different then from what we heard yesterday was that Saudi Arabia signals an ambition for $80 oil price. Then just to layer this over again and to really give you a cleanest example of the fairly tensious issues that we have between Saudi and Iran. Saudi yesterday was saying they want $80 oil. Iran's oil minister this morning, happy with 60, and actually 70 is too high. So again, the two countries still at loggerheads somewhat. On the oil front, finally, of course, Tuesday night, we did have the API crude oil inventories, so I'll recap these later on this evening, but to give you a quick flavour of what we had. The headline was a surprise build, 1.758 million, Cushing a build of just shy of 1.5, gasoline a build 2 million, distillates a draw of 3.8 million. What happened overnight? Well, this was the API reaction, if you can quite make that out. This is oil, RBOB gasoline, so everything shot lower in response to the data from last night. It is in the chat room if you need to have another look at it. Okay, a few other things. I did think this is quite interesting. You don't really hear about these things, but I think just to open your mind about how politics works in reality, whilst China is talking quite diplomatically on the trade front, don't forget, it's not all a done deal. China is actually conducting huge military drills in the contentious East China Sea at the moment, which obviously has a high presence of US military bases. And so it is, even in this age and era of the nuclear deterrent threat rather than physical man-to-man confrontation, there still is a lot to be said for flying 20 F-18 fighter jets over the East China Sea with a nuclear-enabled US Theodore Roosevelt aircraft carrier. Nothing helps the diplomatic negotiation than a little flex of muscles, and definitely this is going on as well at the moment, which is again just quite interesting, something you don't read on the front page but definitely is happening. Anyone trading the FTSE this morning, you'll probably have recognized that the FTSE 100 is seeing a little bit of outperformance again its European counterparts. That's because Tesco, which is one of the FTSE heavyweights, reported earnings this morning. They beat guidance with a 28.4% rise in full-year profit, underlying the recovery in Britain's biggest retailer. What I typically do then, just to have a look at how this is shifting the FTSE, this is on Teletrader. You can see the FTSE 100 top gainers and losers. The FTSE is up, or Tesco is up, 5%. And if you're talking about Tesco, of course, you're talking about one of the biggest components within the index in itself. So pretty strong move seen in Tesco this morning on the back of that. All right, quick look at the calendar. A few things to get through. So we've already had the inflation numbers overnight in China, which were a little bit weaker than expected. Looking forward to this afternoon, or for later this morning, firstly, because we do have some UK numbers. UK construction, industrial output, manufacturing output. Is this going to have a real big influence over the price of the pound? Well, sure, if it's outlying enough. But if you actually start looking at the data, I mean, just take industrial output for an example. If you take the month on month, although it's expected at 0.4, you've got a range of minus 0.5 to plus 0.7. So pretty large range. And even if we get a negative print, there are some banks on Wall Street expecting that kind of more pessimistic view. So I don't really think we're going to get too much from this, but nonetheless, I definitely wouldn't be carrying a position of any size over the release of that data. I think you're better off to just hear what comes out and then potentially make decisions thereafter. With that being said, overall, if you were thinking about the allocation of your funds or capital you'd like to trade, or more importantly, your attention and your energy, both physically and mentally, I 100% suggest that you sit on your hands and wait for this afternoon. If you trade this morning, you're probably going to end up trading a market that's not really going to see too much action, and then all you'll do is end up putting yourself potentially in a negative position. The best, most cleanest and obvious moves will occur this afternoon, and you're already at your risk kind of limits, and that will not enable you to trade what potentially could be the best part of the day. So I think when you come in the morning, and I'm talking like this for the newer traders more so, always look ahead and think about the day as a whole, and where is it that what is going to be the catalyst. And we know that at the moment these financial markets aren't being driven by China really when it comes to economic data. Is low CPI going to move and change global sentiment about what we're going to do this morning? No, it's not. That's already evident from this morning. What is driving financial markets is America, it's Donald Trump, it's trade talks, and as a net effect, it's the Federal Reserve's decision making. Now, there's a few things then you need to be aware of today. First off, US CPI, 130. Very important because of, as we know, the Fed uses this as a real barometer for their decision making, dependent on how aggressive inflation has been rising or not. Because remember, beginning of February, the initial catalyst for this correction that we've seen in the US equity market came from what was, at the time, higher wages. But since then, inflation's been relatively lackluster. The interesting thing about today is if you look at the core CPI on your calendars, the previous reading was 1.8%. Expectations today are for it to go to 2.1. So we're looking for quite a big jump here of 0.3 in the inflation reading. Here's what it looks like on core US CPI on the chart. So we've been tracking basically at 1.7 and 1.8 consistently for about a year almost. If we get a reading up at what is expected, 2.1% on the core year on year, look where that puts us at 2.1%. We're off this chart. We need to go back to a 5-year chart. That puts us back up to levels seen here, just above the peaks, what would have been seen 2013, 2014. That's a meaningful increase here that we would see. If that does not materialize, that's going to be interesting then for those aforementioned levels that we were looking at. More upside potentially in euro dollar and cable to breach those significant long-term technical resistance levels. If that comes true though, definitely this could be interested to see, can the Fed remain, this is the question, even if inflation is rising, how much more hawkish can the Fed get when you've got Donald Trump causing all kinds of havoc at the moment on the trade front? Now this is what we're going to be looking at later on this evening, because then this is the second part of the key events of today, and that is you get the FOMC minutes later on this evening. So quick look back onto your calendars, 7 p.m. London time. What's going to happen is the Fed minutes to hint at how trade SPAC could affect the outlook. This is what me and every investor in the world is interested in. So far, Federal Reserve policymakers have been publicly cautious about what a US trade dispute with China could mean for that outlook if it escalates. To give you an idea, at the end of last week, Jerome Powell, the Fed chair, had a speech. And during that speech, he did not mention the Trump administration's trade dispute with China in his prepared remarks. He subsequently told people in the audience that the central bank's business contacts have described trade disputes as, quote, a bit of a risk to the outlook. The key thing here is, of course, has now that phrase changed? And how much emphasis are they putting on this deterioration in the global trade situation as to shackling the ability for them to continue to get more aggressive rate hikes? I think at the moment, this trade front for me, if I was a central banker, would probably make me more cautious, and therefore, yes, economic prospects are improving, interest rates should rise, as they have been in the US, but we should just continue on track with the two of which we've always said we were going to do. That's kind of my baseline scenario of I think what will happen here. A couple of things though to consider. Tariffs were likely not incorporated in the forecast because the details are still very scant. So at the moment, you would think that the March summary of economic projections, this dot plot matrix, how can it take into account the trade tariff talk? Because we don't really know the trade tariff details at this point, certainly not when the March meeting was taking place. Some analysts believe that tariffs could raise some prices, which officials may view as a one-time shock that they would be happy to look through, much like a jump in oil prices, rather than a lasting source of inflation. So think about it. Although it has heated up on this idea of protectionism and the retaliation that could come, prices could spike, but is this just a one-off effect? And is Donald Trump just using this as a political posture ahead of the midterms, and therefore it will dissipate over time and inflation won't be spiked for a consistent long period, which would require higher rates? This would be supportive of the more dovish contingent. The other thing is, escalating trade protectionism could also slow growth, of course, increasing cautiousness of policymakers. So in that sense, is GDP, we've looked at these charts before, if this did actually go to the part of implementation and an increase to the point of to the detriment of all players involved, China, US and the rest of the world, if this slows GDP forecasts, then how can the Fed remain in such a hawkish mindset? They probably can't, would be the answer. So this is what we're looking for later on tonight. So if you're going to be at home watching the event, that's going to be probably the key point of which will define the market's reaction thereafter this evening. Okay, quickly, speakers. few to look out for. ECB's handsome. You've got Mario Draghi is actually speaking in Frankfurt, but he's speaking with the winners of the Generation Euro Student Award. So I wouldn't say this is a headline speech. However, whenever Draghi does speak, I would always pay at least 2% at this point for the just in case he makes a doorstep comment, especially in the wake of the comments from Novotny yesterday. If I was a journalist and Draghi was there at a student conference, what would I ask Draghi? I would say, what do you think about what Novotny said yesterday? Agree or disagree? And so, who knows? It's something definitely I'd be mindful of as a minor risk to euro price movement. Okay, guys, that's it. Going to wish you all a good day. Plenty to come in the afternoon, as I say, so just keep that in mind. Good luck, and I'll see you in the chat room. Thank you very much.